Hey guys, KYT here with another video. What are you pointing at? What? Is that is that your RESP account? I really don't know what she's complaining about because she's killing it. Like, look at this. Basically 10% return. Good job, June. In this video, we're going to be talking about the dividend capture strategy. It's nothing new, but it's popular enough, it's searched enough that I figure it's a good idea to add it to my library of videos just so people can get my perspective on the strategy. So in my last video, I talked about my friend who lost 90% of his WealthSimple portfolio doing some questionable stock picking. And now with the remaining amount, he says he's committed to testing the dividend capture strategy. He's tested it before, but this time he'll go all the way with it. At least that's what he claims. And you can follow him on Twitter to track his progress. And he started off by trying to cycle some dividend cycling, or I mean, on YouTube, some people call it dividend stripping even, with the Canoe ETF as his first one. And then he's going to see go for his second dividend run. So it'll be interesting to see what happens. So what exactly is the dividend capture strategy? I think this graphic and this text really defines it. So I'll just read it for you. Dividend capture works by purchasing the stock before the ex-dividend date and then selling it on or after the ex-dividend date. You only need to hold the stock overnight on the day before the ex-dividend date to receive the payout. And short-term traders can time their buys and sells to coincide with the dividend calendar of their preferred companies. So if you look at something like Canoe Financial, you can see their ex-distribution or their ex-dividend date is July 20th. So to be eligible to be paid their dividends on August 15th, you need to buy the stock the day before, either the 19th or multiple days before. It doesn't have to be exactly the 19th. So that's why he bought it on July 17th to be eligible for the dividend. And usually people will sell it once the share price returns to its original level or is above its original level. And here's why. So I'm going to show an example, and I'm just going to use really round numbers so it's really easy to understand. So if the share price is $100 of a dividend company and you have one share and it's giving out 5% dividends, you would expect the stock price of the company to drop roughly 5% on the ex-dividend date. Now, it's not going to be precise. You're going to hear how, it's not exactly going to drop by 5%, but the company has 5% less money on hand because it's paying it out to all the investors. But the reason why it's not exactly 5%, it's still the buying selling price is how investors evaluate the company. So it's never an exact value. It's what everyone thinks the company is worth on a given day. And that could also be affected by different market news, investor sentiment. So a lot of factors are affecting the price beyond just the dividend. But usually you'll see a drop if there's no other news. Everything being equal, it will drop by about 5%. So in this case, the share price, let's say, goes like $95. And you get a dividend of $5, your total, maybe not return, but your total asset, your total share, what you see in your account is still $100 when that ex-dividend happens. So what you're hoping to do, what most people are hoping to do, is that the share price returns to $100 quickly, because there's a sudden drop. People think it's a dip and people are just going to buy it up and go back to 100. And then you're able to get $105. So you essentially sort of grab the $5 freely is what the dividend capture strategy is about. And we can see my friend Calvin employing the strategy because he bought it. Like I said, he bought it on the 17th right over here, and he sold it on the 21st. So he's going to be paid the dividend on August 15th, but he was able to get in, be eligible for the dividend, and sell it on the 21st. And notice here, the ex-dividend date was on the 20th, and you can notice this significant drop that can be seen. And I think the EIT income dividend is fairly large, relatively speaking, which is why the effect is usually more noticeable on stocks like this. So didn't Calvin just prove with this first buy and sell that dividend capture works? Yes, like if you define it as being profitable, sure. But my point is that dividend capture, at least my conclusion after researching, is that it is kind of like a pointless exercise. And I'll show you what I mean. You can't really judge a strategy by whether it's profitable or not, at least in the investing world, because there's so many viable alternatives. if one thing you can make $1 out of it, but there's a common popular strategy where you can make $10, obviously making $1 is going to be a mistake. So if we go back to my sheet here, this is scenario 1. Scenario 2 is, what if you just bought the stock on the ex-dividend date when it drops to 95, and then you wait for it to go back to 100? You would make the same amount of profit without receiving a dividend. So again, it's not clear to me which strategy is better. It's not obvious. Or what if you just bought a stock that's priced, let's say 95, and you're waiting for it to go to 100? You're making the same amount of profit. So again, the only reason why dividend capture strategy might be special is if you think that it goes back to 100 faster than other types of stock. You think like people are seeing that, oh, it dropped a lot, so it has to go back up fast, so I'm going to get it. I've seen that in YouTube comments. They have apparently seen stocks historically go back up really fast, but I really think that's a little bit of a selection bias. So I've been watching a lot of these videos to prep dividend capture, and in the comments, there's some interesting comments for sure. This one's from Samantha Powell, 5882. Just wait until the price recovers before selling. So again, this is ignoring opportunity cost, because what if you just bought an index and didn't do this dividend strategy? You wouldn't have to hold a stock until it recovers to break even. And I've seen videos of people employing the strategy saying, oh, I've had to wait a long time before it recovers. So you have to compare this strategy versus an index. And then there's this commenter had an interesting comment. So I'm about to be starting a strategy. This video helped explain the risk better for me. However, I'm still going to try with a slightly different approach. If it works, then great. If not, then I just learned another thing not to do in the market. We know that even 3 years of data is statistically not really significant. So when people, I've seen a lot in these comments, when people say they're going to try a certain strategy, that's really dangerous, because you can convince yourself that it works with an even smaller sample size, like weeks or even months, and convince yourself that it works. Really dangerous stuff. And I think this guy that I stumbled upon describes the thought process really well. And I want to respond to what he's saying right after.
Strategy, I'm buying stocks that are in an uptrend. I collect the dividends. And even though the price goes down on ex-dividend date, I know that since the stock is in an uptrend, later on the price will go up again and I will be able to sell the stock.
So going back to the opportunity cost thing, it needs to be compared to different strategies. If the strategy works when the market is on the uptrend, that definitely likely means that if you just held the index, you would be profitable as well. So the question remains whether this whether it's worth the effort of tracking all these ex-dividend dates and then putting your money in these stocks. My answer is pretty obviously no, because when you're doing the strategy, like my friend Calvin is, you are focusing specifically on these stocks to do this whole rotating thing. So if you're not new to the channel, you know diversity and being diversified is very important. So when you're just cycling through a specific set of stocks that do well, like this strategy does well on the uptrend, when an index does well anyway, you are exposing yourself to concentration risks that you otherwise wouldn't need to do. So let me ask ChatGPT what it thinks. I asked it, isn't dividend capture strategy pretty pointless if the market is fairly efficient? Because some of the logic people have is that they don't know, the market doesn't know the ex-dividend date. So they might see a stock drop and then rush to buy it back up to its original price. And that's why people theorize that there's some inefficiency there. But we know that a lot of people know about this. So there is no point. And that's why I'm like, isn't dividend capture strategy pretty pointless if the market is fairly efficient? Yes, you're correct. The dividend capture strategy is often considered an ineffective or suboptimal approach to investing, especially in a market that is reasonably efficient. It doesn't have to be completely efficient. The strategy involves buying a stock just before its dividend date, the date on which the stock starts trading without the dividend, and then selling shortly after to capture the dividend payment. The idea behind the strategy is to generate income from the dividend payment without holding the stock for an extended period. However, several factors work against the success of the dividend capture strategy. market efficiency, transaction costs. There's dividend tax treatment, but you can ignore like 2 and 3. 2 if you invest on WealthSimple. 3 again if you're doing it in a tax-free account, then it's fine. Limited time frame, increased risk. I think I talked about this. And competition. The dividend capture strategy is popular among retail investors. So like some would argue people are clueless about the dividend dates, but then other would argue that a lot of people are doing this, what Calvin is doing. So if a lot of people are doing this, there is no edge anyways. So that's why I've challenged Calvin. He can't just be profitable. That's not enough. He's got to be able to beat a specific benchmark, a typical benchmark rather, like this one, VCN, Vanguard, FTSE, Canada All Cap Index ETF that grabs a lot of Canada stocks. And we'll see what happens. Hopefully he doesn't give up on his strategy and keeps us posted on his Twitter. And my theory is that VCN will outperform a dividend capture strategy. Of course, there is short-term variance where he can absolutely crush, as shown with his first cycling. He was profitable very quickly because he bought on July 17th and sold it on July the 21st. Like just in a span of days, he was able to capture that dividend. But I think over time, we're going to see that concentration risk and all the other things play out. And in theory, it should underperform VCN. I'll end this video by showing this guy who actually did this experiment a year ago. And let's see what he has to say.
I wanted to explore for you guys with this 3-part series. And the results are in. And no, it wasn't. For you guys, I put $25,000 in my Robinhood account, and then I did this. Every day for the month of July, I was jumping in and out of ex-dividend paying stocks. And
so he goes on to say that the market is pretty efficient. Investors know how to value dividend stocks properly. So that's why he thinks it doesn't work. And I think if he started a year ago, the market was on a downtrend, which explains why. So it's not that dividend capture doesn't work or isn't profitable. It's just there's nothing special about it. So even in the comments, there's a lot of people, well, I did this year and it worked for me. You know, we're not arguing that it can be profitable. If you take anything from this video, it's the fact that there are other strategies that are better without this effort, without having to jump in and out, just hold an index. I mean, I can guarantee, guarantee is the wrong word. It just came out of my mouth, but it was a strong bet that XEQT would beat Calvin's strategy easily over the long run. And with that, I'll see you in the next one.